Welcome to today's program titled PPP, Loan Forgiveness and Other Lending Program Updates. At this time, all participants are in a listen-only mode. For those of you who are logged into the web presentation, you are encouraged to submit questions when prompted by typing them into the text box on your screen. For those interested in obtaining CLE credit for this webinar, an attendance verification code will be read during the presentation that will be required on the CLE attendance affirmation form. Please write this code down. It will not be reread, and it is required for your CLE credit. Copies of the webinar recording and materials will be distributed to attendees in the days following the webinar. At this time, I would like to turn it over to Stanley Jukowitz. Stanley, you may begin.
Thank you, and welcome everybody to the Seyfarth Shaw Grant Thornton webinar on Paycheck Protection Program loan forgiveness and other lending program updates. Next slide, please. In addition to me, our speakers are Doug Crisatello, who is the Managing Director in the Public Sector at Grant Thornton, Sal Kermanova, who was Counsel at Seyfarth Shaw, Leslie Kersey, who was also Counsel at Seyfarth Shaw, and William Eck, who was a partner at Seyfarth Shaw. Next slide, please. Our legal disclaimer. We'd like to invite everyone to visit the Seyfarth Shaw COVID-19 Resource Center. We have articles and information relevant to all topics, legal topics dealing with the COVID-19 pandemic, and we have the web address on the screen. Next slide, please. Our agenda today will consist of a legislative update, Main Street lending programs, SBA lending programs, the PPP loan forgiveness, and then Q&A. And please note that the Q&A box will be available to you beginning at 1:30 Eastern Time, 12:30 Central Time, to type questions where indicated. Next slide, please. Now I'd like to turn it over to Doug Crisatello for the legislative update. Doug?
Before getting program, as of last minute, $3 billion in assistance, nearly $4.5 billion. But importantly, over $150 billion in funding remains available for firms that have not yet received help under the program. So let's get into the legislative update. Next slide. The House last week passed a bill about 4 weeks. Deadline to rehire workers to the end of the year. The bill would also reduce the share of PPP funds that have to be used for payroll to 60% from the current level of 75%. And the bill would also increase the loan term of any amount that's not forgiven to 5 years from 2 under current law. Finally, the bill would also allow payroll unallowable under current law. So that bill now goes to the Senate. The provisions in the House were drafted to keep bipartisan support and action in the Senate as soon as this week. Now, importantly, the bill.
Ladies and gentlemen, we're having some connectivity issues. Doug will sort out the connectivity issues momentarily.
I'm on the line. Oh,
Doug, there seems to be an issue with your phone. Is it possible that you can hang up and dial back in? And meanwhile, is there someone who could take over?
okay.
Stanley, is there someone who could take over at this time?
Yes, I can pick up the so as the slide indicates, the House recently passed the Paycheck Protection Program Flexibility Act, which gets taken up by the Senate, and that will change the nature of the Paycheck Protection Program significantly. It's going to extend the coverage period from 8 weeks to 24 weeks. It's going to extend the date of exemption for rehires from June 30 of this year until December 31st of this year. Currently, the payroll must be consist of 75% of the covered expenses under the program for forgiveness, and the Payroll Protection Program Flexibility Act would reduce that to 60 years. It would increase the term of the loan from 2 years to 5 years, and it would allow payroll tax deferral for forgiveness recipients. Right now, the federal portion of the employer's portion of the payroll tax is not subject to loan forgiveness, and the Flexibility Act would make it subject to forgiveness. We are awaiting some indication from the Senate as to when they will take up the Payroll Protection Program Flexibility Act. The Senate is now back in session, and so we wait the majority leaders' timing on this, and we are hoping and in some cases expecting it to be taken up this week. And again, if the bill is enacted, it will require substantial strategy changes to forgiveness applicants, and for those who are not prepared to receive full forgiveness under the current configuration, they might wait until this passes. I'm told Doug is back with us, and so I'm turning it back over to Doug.
Okay, great. So it sounds like we can move on to the next slide. Clearly, the pandemic is far from over, so it's important to continue monitoring Congress for additional legislation that could help fortify the national economy. I won't go through this slide in detail, but the HEROES bill recently passed in the House would approve an additional $3 trillion in spending, and that's roughly equal to amounts already provided for pandemic response. And while the Senate hasn't clearly signaled its interest in additional funding, pressure will build to pass something if the pandemic worsens or even persists at its current level of disruption. And while small business assistance is not a key part of the HEROES Act, we may see renewed efforts to support small firms as PPP funds are exhausted. Next slide.
Okay, now we're going to have Asel Kremenova discuss some features of the Main Street lending programs, or actually the three components, three different types of loans comprising the Main Street lending programs. Asel?
Yep. Hi, Stan. Hopefully everyone can hear me well. Hi, everybody. Today I would like to give you an overview of the Main Street lending program, the types of the loans that will be made available pursuant to this program, and certain other key details. Next slide, please. Okay, so Federal Reserve designed the Main Street program to support small and medium-sized businesses that were either unable to access the PPP funds or that require additional financial support. The Fed will administer the program through the Federal Reserve Bank of Boston. As you can see on this very helpful chart that was provided by the Boston Fed, the Boston Fed will commit to lend to a special purpose vehicle on a recourse basis. And then the Treasury Department will also make up to a $75 billion equity investment from the funds that were appropriated under the CARES Act to the Main Street SPV in connection with this program. And then the Main Street SPV will purchase up to $600 billion in participation in eligible loans, ranging from 85 to 95% of the applicable amount of the underlying loans. The program is authorized to run until the end of September of this year, unless extended, at which time the Main Street SPV will cease purchasing loan participation. The Boston Fed will continue to operate the SPV after September until the SPV's assets mature or are sold. At this point, the program is not yet operational. However, on a recent webinar, the representatives of the Fed indicated that even though there's no set date, they're very close to commencing the program. There are also some indications that the Fed will continue to assess the situation and may adjust the size of the program in the future if necessary. Next slide, please. So the Main Street program consists of 3 facilities called New Loan Facility, Priority Loan Facility, and Expanded Loan Facility. You can see the chart in front of you that highlights key features for all these 3 facilities. The new loans and priority loans are designed to facilitate the extension of new credit. In contrast, the expanded loans are for extension of additional credit, which is also referred to as upsized tranche on existing facilities between an eligible lender and an eligible borrower. I guess the main and maybe the most obvious point about these loans is that they're not forgivable and have to be repaid. To be eligible for new loans and priority loans, the loans must have been originated after April 24, 2020. And for the upsized tranche, the existing loan must have been originated on or before April 24, 2020. Also, the existing underlying loan must have a remaining maturity of at least 18 months at the time of upsizing. As you can also see on this chart, all of these loans generally share a number of same features, including the maturity, interest rate, deferral of principal and interest for 1 year, and ability of the borrower to prepay without penalty. Also, all of these loans will have a 4-year term. The minimum size for the new loans and priority loans is $50,000, and for the upside tranche is $10 million. The maximum principal will vary for these loans and also depends on the borrower's 2019 adjusted EBITDA. This was one of the more significant recent changes announced by the Fed, where the calculation of the maximum loan amount was changed to be based on adjusted EBITDA rather than EBITDA. Therefore, even if an otherwise eligible borrower has 0 EBITDA, as a result of the adjustment, it may potentially have a positive adjusted EBITDA and may be able to borrow under the program. In its guidance, the Fed clarified that the methodology the lender should use for determining the borrower's adjusted EBITDA is a methodology previously used for adjusting EBITDA when extending credit before April 24, 2020 to the applicable borrower or similarly situated borrowers, meaning that it's borrowers in similar industries with comparable risk and size characteristics, for example. For the upsizing, the lender should use the same methodology used when originating or amending the existing loan that is being upsized. In addition, the Fed indicated that if a lender has used a range of EBITDA adjustment methods in the past, the lender should choose the most conservative method. And in any event, it should be a method that was used recently. The lender may not cherry pick various adjustments in order to calculate EBITDA. In addition, the lender is required to document its rationale for choosing specific adjustment methodology and will also have to make certifications about it. While, as a general matter, there are no limits on how much EBITDA can be adjusted, the Fed has indicated that it believes that the program has various important features that are generally designed to limit excessive risk-taking, and as a result, they don't think there's going to be unnecessary or unreasonable EBITDA adjustments in this respect. In addition, as noted earlier, the Main Street SPV will purchase up from anywhere from 85 to 95% of the underlying loans. And as a result, the lenders are required to retain 5% of the principal of the new loans and upsized tranches and 15% for the priority loans. For the expanded loans, the SPV will purchase participation in the upsized tranche only and not on the existing loan. This idea is basically that by selling participation to the Fed-backed SPV, the lender will significantly mitigate its credit risk and capital costs. And in this manner, the lenders will be more willing to extend credit at favorable terms to eligible borrowers and therefore support the economy during the pandemic. Next slide, please. Okay, so in order to be eligible to participate in the program for the borrower must meet several tests. As a result of implementation of the program, the Fed issued several rounds of guidance, and the overall effect of the guidance is such that now, as a general matter, a larger universe of businesses can participate in the program. So for the borrower to be eligible, the first test it must meet is the U.S. presence test. This is basically the test where the borrower has to establish that it's a for-profit business, first of all, that was established prior to March 13, 2020. It was created or organized in the U.S. or under its laws, has significant operations, and majority of its employees based in the United States. The second test that the borrower must meet is one of the size tests. So the first size test is the number of employees, so that the borrower needs to show that the borrower and all of its affiliates together had 15,000 or fewer employees based on the average total number of employees over the 12 months prior to issuance of the loan. Or the borrower has to show that it and all of its affiliates together had 2019 annual revenues of $5 billion or less. For the revenues test, there's some guidance where the Fed indicated that the borrowers can either rely on 2019 audited GAAP financials or annual receipts for 2019 as reported to the IRS. In addition, the borrower must not be on the list of ineligible businesses. Some examples include financial businesses that are primarily engaged in the business of lending, life insurance companies, private equity firms, although portfolio companies of private equity firms can be eligible if they otherwise meet other requirements. The main point here for eligibility for the borrower basically is that unlike for the Paycheck Protection Program, where as a general matter, once the applicant meets the eligibility criteria, its application is processed without additional review, here the borrower first needs to meet the criteria, but then the ultimate decision is with the lender to decide whether or not to extend credit. The Fed, through its guidance, made it very clear that the lenders can apply their own underwriting standards that they typically use and can evaluate the financial condition and creditworthiness of the borrower as they typically determine. And the lenders are also allowed to require additional information and documentation as they think is necessary. For the lenders, here the situation is a lot simpler. Eligible lenders are generally U.S. federally insured depository institutions, and which basically is your banks, credit unions, savings and loans companies, as well as U.S. branches and U.S. affiliates of foreign banks. Next slide, please. Okay, so in connection with the program, both lenders and borrowers are required to make various certifications, and they also have to comply with various covenants. For example, the borrower must certify that it's an eligible borrower, that it meets the applicable criteria we just discussed above. In addition, both the lender and the borrower must certify regarding the eligibility of a particular loan that is issued under the program, and that it complies with the various terms of the program as specified. Both borrower and the lender must commit that they will not cancel or reduce their existing lines of credit with each other or with other applicable parties as the case may be. Also, we discussed, also one of the requirements is that the borrower has to certify that it has reasonable basis to believe that it will meet its financial obligations and it's not expected to file for bankruptcy for at least 90 days after issuance of the loan. This generally reflects Fed's idea that they only want to lend to solvent businesses that are expected to continue to go forward in the ordinary course. There was a requirement earlier that the borrower had to make a certification that it will continue to maintain payroll and retain employees. In recent guidance, the Fed had gone away with that requirement. However, the borrowers still have to use commercially reasonable efforts to maintain payroll and retain employees. In the FAQs, the Fed clarified that commercially reasonable basically means using good faith efforts to maintain payroll and retain employees, all in light of the business's current situation, the current economic environment, the business's available resources, and the need for labor. And more importantly, the Fed clarified that a borrower is not precluded from participation only because it laid off or furloughed its employees as a result of the pandemic. In addition, the borrower must commit that it will follow compensation, stock repurchase, and capital distribution restrictions. However, one of the recent changes that was introduced was that the S-corps and pass-through entities can make tax distributions to the extent required to cover their owner's tax obligations. As a general matter, all of the borrower's required certifications and covenants will be collected by the lender, but the lender is not required to independently verify that those statements are true or correct, and it's not required to monitor compliance by the borrower of the various applicable requirements that are imposed on it. In addition, as discussed above, the lender will have to certify that it calculated the applicable adjusted 2019 EBITDA leverage requirement based on the financial statements that was provided by the borrower, and that the methodology for the calculation was as it previously used either for this borrower or for the similarly situated borrowers. And in addition, the lender is required to make sure that its loan documentation has a provision that triggers a mandatory prepayment in the event the lender receives a notice from the Fed that the borrower has made a material misstatement or breached any of its certifications or covenants. In addition, the lender is also required to report promptly if it learns of any of such misstatement or breach. And then, mindful of time, just a very quick note about disclosure. Parties considering participating in the program should expect that their participation will become public. The Fed has indicated and continues to indicate that it will publicly disclose information regarding participation, which includes the names of the lenders and the borrowers, the amounts that were borrowed, interest rates charged, overall costs, fees, and other applicable information such as revenue. Stan, this is it from my part.
Okay, thank you. Thank you very much, Estelle. Let's move to the next slide, please. Now, Doug Crisatella is going to talk about some of the other SBA lending programs that predated the CARES Act and that are still available to borrowers and oftentimes overlooked with the passage of the CARES Act. So I'm going to turn it back over to Doug.
Yeah, thanks, Stanley. I would mention that SBA does have a number of credit programs that are available in normal times, but the terms of the programs have been loosened since the pandemic. So let me just touch on a few of these. Obviously PPP gets most of the attention, but these other programs could be of interest to you. Existing borrowers and firms have an opportunity to get debt relief through SBA right now. So anyone with an existing 7A, 504, or microloan through SBA, or any new loans that are originated between now and September 27th, that date is 6 months after enactment of the CARES Act. That's the magic of that date. They're eligible for this debt relief. So SBA is actually picking up 6 months of principal and interest for borrowers through those programs. it's actually quite generous, and it's not just a deferral. It's actually SBA paying those payments for a half year. SBA also runs an economic injury disaster loan program to assist small firms experiencing a temporary loss of revenue due to a natural disaster, a pandemic in this case. This is one of the primary forms of support that SBA provides. So after a hurricane, SBA goes in and provides both physical and economic injury loans. The entire nation has been declared disaster eligible for these loans. You may have heard that SBA was providing advances of up to $10,000 for firms applying for, what is known as EIDLs. They've had just a huge influx of applications for disaster loan, similar to the Paycheck Protection Program. So right now, they are only accepting applications from agricultural businesses due to limitations in funding and the number of applications that have already been received, but that program is worth monitoring going forward. SBA also administers a bridge loan program that's helping small firms with immediate needs while their disaster loan applications are pending. Again, not terribly relevant right now as SBA is scaling back, accepting new applications, but it is helpful for folks that have those applications pending. Can we go to the next slide? And comparing and contrasting the Main Street Lending and SBA programs, it really should be emphasized that PPP is the only program with a forgiveness feature. The other programs require repayment. They're loan programs. While firms with up to 15,000 employees or $4 billion in revenues, as we mentioned earlier, are eligible for Main Street Lending, it's best suited for larger small firms and medium-sized businesses. The loan amounts are significantly higher than can be obtained through SBA for its sort of mainline programs. But the loan terms are generally much shorter. The maturities are much shorter. SBA loans, the Small Business Administration, right? The loans, as the name suggests, are directed at small firms. SBA size standards apply, and loan amounts are lower than Main Street Lending, but long-term financing is available. So that's a real advantage of sort of SBA's mainline 7A and 504 programs. The interest rates and deferral policies across these various programs, Main Street and SBA programs, are fairly similar. So that's not the big driver. I really think if you're a small firm in need of long-term financing, you might want to take a hard look at SBA's programs. Just a couple of final points worth noting. PPP recipients are eligible for Main Street Lending, but cannot use other SBA loans for the same purpose. They may be eligible for SBA loans for different purposes, but not to basically pick up payroll as they've been doing with the PPP proceeds. There's also some other credit programs that we're not going to go into any kind of detail in our webinar here today that are for specific industries and type of businesses through the Federal Reserve Board, which we've been talking about, and also the Export-Import Bank. So I just wanted to mention that. And then finally, there's tax relief programs available, such as an employee retention tax credit and payroll tax deferral through the IRS. So there really is a host of programs available across government to support business. So with that, I'll go to the next slide.
Thank you, Doug. Now we're going to get into the heart of the PPP loan forgiveness programs, and there are a number of complications. There are a number of issues that are still outstanding. And again, if the Paycheck Protection Program Flexibility Act passes, many of these changes may not be, many of these principles may change. But again, we're endeavoring to give you the most up-to-date information, and as of quite literally a couple of hours ago, there has been no change in the guidance or in the legislation. So I'm now going to turn it over to Leslie Kersey and Bill Eck to get into the issues regarding Paycheck Protection Program loan forgiveness. Leslie?
Thank you, Stan. As Stan just mentioned, there's a lot of optimism that as early as in the next couple of days, we may see some statutory changes to how borrowers will be permitted to determine their PPP loan forgiveness amounts. But in the meantime, many borrowers are concluding their 8-week covered periods now and looking to understand how the existing forgiveness rules work and whether they're currently in a position to receive maximum loan forgiveness. So far, SBA and the Treasury Department have published a loan forgiveness application, a handful of FAQs, and several interim final rules touching on forgiveness in one way or another. And most recently, on May 22nd, the SBA published its long-awaited, much-anticipated interim final rule on loan forgiveness, which provided additional details and instructions on calculating loan forgiveness amounts and any required reductions. The PPP loan forgiveness application instructs borrowers that their maximum loan forgiveness amount will be the lesser of three amounts: the principal amount of the loan, total forgivable costs less reductions for decreased salary and wages or employee headcount reductions, and third, 75% of payroll costs. While the general rule is that PPP loans can be fully forgiven, and SBA has previously advised that the amount of loan forgiveness can be up to the full principal amount of the loan plus any accrued interest, the SBA loan forgiveness application currently does not provide an opportunity for borrowers to include the amount of accrued interest in the forgiveness calculation. So one open question is how or whether accrued interest on a forgiven amount will be waived. Consistent with the CARES Act and prior SBA guidance, the amount of loan forgiveness is subject to reduction if the borrower has reduced employee headcount or employee salary or wages, unless a safe harbor applies, and we'll go into more detail on that shortly. And additionally, based on current SBA rules, 75% of the forgiveness eligible amount has to be used for payroll costs. The loan application quite helpfully makes it clear that it's not an all or nothing test. That is, borrowers won't lose the ability to receive forgiveness completely if 75% of the loan proceeds aren't used for payroll. However, no more than 25% of the amount the borrower receives forgiveness for can be used for non-payroll costs. Again, the 75-25% split may change if the House bill passed last week becomes law. The May 22nd interim final rule also brings some relief to some borrowers who had concerns that the SBA might require that some or all of the funds be paid back immediately if SBA determines they were not eligible for a loan. Based on the latest SBA guidance, if only a portion of the loan is forgiven or if the loan forgiveness request is denied altogether, including because the SBA has determined the borrower is ineligible because of the borrower certification as to its need for the loan. The borrower could not make that certification. The borrower will still have 2 years to repay any remaining balance due on the loan. Right. So to calculate a borrower's maximum loan forgiveness amount, the borrower must aggregate forgiveness eligible costs and expenses incurred or paid during an 8-week period following disbursement of the loan. For now, a borrower will add up payroll costs incurred or paid during the 8-week period beginning on the date of the first disbursement of PPP loan proceeds, which is the covered period, or if the borrower has a payroll cycle of every 2 weeks or a more frequent payroll cycle, for administrative convenience, the borrower can choose an alternative payroll covered period, which is the 8-week period beginning on the first day of the borrower's first payroll cycle after it receives the loan proceeds. There is no alternative covered period for non-payroll costs, only for payroll costs. For eligible non-payroll costs, borrowers' rent, mortgage interest, and utilities, the borrower will aggregate expenses paid or incurred during the 8-week period beginning on the date of the loan disbursement only. Of note, for now, partners and seasonal business borrowers who have applied for an upsized loan will also be subject to the same 8-week period rule based on the date of the first loan disbursement, even though they may have different loan disbursement dates for the original loan amount and the upsized loan amount. So this may be particularly tricky for those borrowers, and we wouldn't be surprised if there's some updated guidance from the SBA on this point. So before the loan application and the May 22nd interim rule were published based on the language in the CARES Act, there was uncertainty about whether payroll and other forgiveness eligible costs had to be both paid and incurred during the 8-week covered period. SBA adopted a broad pro-borrower interpretation of the paid and incurred language, and the May 22nd interim rule in the loan application make it clear that borrowers generally will be allowed to include both costs that were paid during the 8-week covered period or alternative covered period in the case of payroll costs, including costs that were incurred in a prior period, and costs that were incurred during the applicable 8-week period and paid during the covered period or shortly thereafter, specifically before the next payroll date or in the case of non-payroll costs before the next billing date. For most borrowers, this is really helpful formulation, and it means that in practice, borrowers will be allowed to get forgiveness for costs that were incurred over a period of more than 8 weeks. For example, subject to the $15,385 per employee cap on forgivable cash compensation, a borrower could count towards forgiveness eligible payroll costs, bonus amounts, for example, earned during a period prior to the 8-week cover period, as long as those amounts are paid during the 8-week cover period. The latest SBA guidance also helpfully makes it clear that employers can increase forgivable payroll costs with hazard pay and bonuses, again, so long as the cash compensation amount for any individual is not more than $15,385. This is good news for borrowers looking for ways to maximize payroll costs in order to maximize loan forgiveness amounts. For many borrowers, increased contributions for retirement and health care paid during the covered period, for example, will also be a good strategy for maximizing loan forgiveness. However, on this point, the SBA introduced some uncertainty in the loan forgiveness application and in the May 22nd interim final rule by introducing a new category of employee, the owner employee, and announcing caps on the amount of the loan forgiveness available for owner employees' payroll compensation. The interim final rule states that the amount of loan forgiveness requested for owner employees' payroll compensation, including employer retirement and health care contributions, is capped at the lesser of 8/52 of 2019 compensation, or $15,385 per individual in total across all businesses. There are a number of new issues here for borrowers to consider with respect to owner employees. The May 22nd interim final rule that introduced this concept did not define owner employee, and it's not defined in the CARES Act, so it's currently unclear which employees are subject to the flat cap on compensation. And, for example, it's unclear whether the term includes any employee who's also a shareholder of a corporation, whether or not they have smaller nominal interest, ownership interest, or who may have no control over management. Also, the rule specifies that this $15,385 cap applies across all businesses, and this is the first time that the SBA has used this reference to across all businesses. So this appears to mean that owners of multiple businesses that each pay the owner a salary are only going to receive loan forgiveness of $15,385, one time. as opposed to each business receiving that amount. And that may be inconsistent with how the original loan amount was calculated. As noted earlier, for both payroll and non-payroll costs, borrowers generally can include both costs that were paid during the 8-week covered period, including costs that incurred in a prior period, and costs that were incurred during the applicable 8-week period and paid during the covered period or before the next regular billing date. This means that if a borrower has an unpaid rent payment incurred in January, for example, the borrower can use PPP loan proceeds during the 8-week covered period to pay that rent amount and could count the payment towards forgivable costs. Again, the forgivable non-payroll costs can't exceed 25% of the loan forgiveness amount, and SBA has noted that the 25% cap on non-payroll costs acts as a governor on excessive inclusion of non-payroll costs in the overall forgiveness amount. So those are just a few highlights from the latest loan forgiveness guidance on eligible loan forgiveness amounts. There's lots more to digest in the underlying guidance, and we expect to continue to see updates and clarifications coming from SBA and the Treasury Department. But for now, Bill, I'll turn it over to you to walk through reductions to loan forgiveness amounts and ways borrowers may be able to avoid those reductions.
Okay, this is Bill Lack. I will take off now, and preliminarily I have an announcement, which is that the CLE number for this webinar is S as in Seyfarth, S as in Shaw, 1137. That's S as in Seyfarth, S as in Shaw, 1137. Today I'm going to cover reductions in the PPP loan forgiveness amount. There are 2 reductions to the loan forgiveness amount in the CARES Act. The first is for wage and salary reductions. There is a dollar-for-dollar reduction for the amount of salary cut for any employee employed by the company during the covered period or alternative payroll covered period, which Leslie referred to, in excess of 25% of the employee's total salary or wages for the first quarter of 2020, subject to limitations that are noted in the slide. I would only note that there is no reduction in forgiveness for cuts to those who make in excess of $100,000 in 2019. So that's sort of a safe harbor for reductions. Again, for those who make in excess of $100,000, it doesn't affect the reduction amount. Second, there are FTE reductions. The forgiveness amount is reduced proportionally for reductions in the average number of FTEs during the 8-week covered period compared to the average number of covered employees per week during a reference period chosen by the borrower. The reference periods are noted on the slide, so I'd refer you to that. Again, the borrower chooses among those periods in the way that maximizes the benefit for the borrower. Next slide, please. There are several safe harbors to reductions in the forgiveness, which eliminate the reductions. First, regarding the FTE sections, there are reductions that do not apply with respect to positions for which a borrower made a good faith written offer to rehire and restore the reduced hours of an employee. There are a number of conditions tied to that are set forth in the slide. The important one that I wanted to bring to your attention is that the SBA in the most recent final rule added a requirement that the borrower inform the state unemployment insurance office of the offer and rejection within 30 days. That does not leave very much time for those who made the offer some time ago pursuant to the FEI's initial FAQ guidance. So you need to take advantage of the exception, be prompt about getting that notice into the state unemployment insurance office. Next, an employee who was fired for cause, resigned, or voluntarily requested a reduction in hours during the covered period or alternative payroll covered period is not counted for FTE reduction purposes. And next, there's no double penalty for salary decline due to FTE reductions. And one item I wanted to note regarding calculation of average FTEs is that for PPP purposes, the SBA uses a 40-hour work week and offers the borrowers a simple method of using 0.5 FTEs for all of those who worked fewer than 40 hours per week. However, this can understate the FTEs if employees work less than 40 hours but more than 20 hours per week. So borrowers really need to calculate the FTEs both actual and using the simple method to see which way they come out better. Next slide, please. Finally, we have the June 30, 2020 safe harbors. The first one is for salary and wage reduction. The exact details are set forth on the slide, but generally, if compensation is cut by more than 25% in early 2020 and the average annual salary or wages of that employee as of June 30, 2020 is equal to or greater than the employee's annual salary or wages as of February 15, 2020, the forgiveness is not reduced. Note here that the implication of average in this context is unclear. Must the compensation be as of June 30 only, or is there some period of time around June 30 that must be included? For example, June 29 or July 1. There's no guidance on this topic. So it's not clear if June 30 is a snapshot or just part of a period. Next slide, please. Now the FTE safe harbor reduction for June 30. If the borrower if the borrower reduced its FTEs in early 2020 and the borrower restored by no later than June 30, 2020, its total FTEs to the level of the pay period inclusive of February 15, 2020, the forgiveness amount will not be reduced. An important thing to note here is that this implies that so long as the borrower had any reduction in this period or after, it can be cured by June 30, 2020. Next slide, please. There remain some open questions. There remain a lot of open questions, and we hope for some guidance, but I'll touch on 3 of them. There's no guidance related to what and if a borrower is required to do after June 30 or the end of the covered period or alternative payroll covered period. It's unclear what borrowers should do if June 30 falls within the covered period or alternative payroll covered period. And if the forgiveness review process is not completed prior to the expiration of the 6-month payment deferral, will or can the deferred period be extended until a forgiveness decision is rendered? Perhaps guidance will be released between now and June 30 by the SBA, but that remains to be seen. Finally, a brief note on taxes. Next slide, please. First, PPP loan proceeds are not taxable income under the CARES Act. And second, expenses paid with PPP loan proceeds and forgiven are not deductible, which dilutes the value of forgiveness substantially. Now, there is some move in Congress to reverse this decision of the IRS, but we don't know where that will go yet. It may pass soon, but we will know we'll find out when that action is taken. And with that, I'll pass it back to Stan for Q&A.
Thank you very much, Bill. We've been receiving a number of questions, and I will try and read some of them out, and I've tried to answer some of them, but I will let's take them in the order they've been received. And the first question is, can a 2020 bonus or any salary increases also qualify in calculating the employee compensation for purposes of the PPP? Leslie or Bill?
Stan, would you mind repeating the question?
Sure. It's the question is whether a salary, whether a bonus paid would be eligible for the PPP loan forgiveness.
Yes, as long as the bonus amount is, this is Leslie, as long as the bonus amount is either paid during the 8-week period or incurred in the period and paid before the next payroll cycle, it would be eligible for inclusion and forgiveness. Of course, it's subject to the overall compensation cap of $15,385 per employee.
And that cap applies, Leslie, another question we've had is whether that cap applies just to the salary, or does it include all of the payroll costs attributable to that employee?
So it appears to depend on who the employee is. So the latest guidance introduced the category of owner-employee, and there's different treatment for owner-employees, partners, and self-employed individuals than just general employees on this point. But for just a general employee of a business, the salary cap is, the cash compensation cap is $15,385, and the healthcare and other benefits paid are not part of that $15,385 cap for general employees.
Thank you. Another question is, are expenses paid by government grants forgivable? And this is a question I've addressed a number of times, and the short answer is probably. And I say probably because if the government grants are paid to the organization, for example, a government grant that is paid specifically to reimburse salary expenses, then the PPP guidance and the PPP program doesn't really address the source of the funds. However, what we've been advising clients is this is really a granting agency issue. A granting agency may take the view that a PPP loan recipient is double dipping, and therefore we advise full disclosure to the granting agency. The granting agency, will respond as it responds, but insofar as the PPP program, if a grant is paid to the organization to reimburse salaries, then it should be eligible for PPP. Next question is, does an EIDL affect forgiveness of a PPP loan, and if so, how? Bill or Leslie?
So the EIDL amount would need to be, the advance amount would need to be reduced, would be subtracted from the overall forgiveness amount so that you're not getting both the advance and an additional amount forgiven.
That's right.
Okay. Question for Estelle is whether a borrower under a PPP program can also qualify for the Main Street loan program, or rather, does obtaining a PPP loan disqualify a potential borrower from the Main Street program?
No, it does not. The Fed was very clear that a company or person can apply for a PPP loan, get the loan, and also apply for the loan under the Main Street.
Thank you. It's a question for Doug. It is my understanding that significant fees are still assessed associated with the 7A loans for which 6 months principal and interest is paid. Can you confirm?
SBA is picking up 6 months of principal, interest, and associated fees. So for new loans, I'm assuming that would all be covered.
No, but the question is, the question is whether the fees are significant that the SBA would charge.
Yeah, I mean, SBA does charge upfront fees, loan origination fees, but, for new loans, I'm assuming that's part of what SBA would contribute, because in the guidance, they've made clear that they're going to pay principal, interest, and fees for new loans.
Okay, thank you. Next question: if using PPP for retirement contributions, such as 401k matches, can it be only for the covered period? And here's an example: if we pay 401k match quarterly, do we have to figure the amount of the match that covers just the PPP covered period?
It should be the amount that accrues in the covered period.
Okay. Can an employer hire a contractor or temporary agency, a special skills temporary agency, and use PPP loan with forgiveness? They would not be on the payroll.
Not if it's an independent contractor.
I think that the advice on this is that it's the W-2. It's for tax purposes as an there are some co-employer arguments for this, but there's not really certainty on the point, and so because the temporary agency reports the employee W-2, that's there's some uncertainty until we get further guidance from the SBA on the point.
Right, and the temp agency or the contractor could apply for a PPP on their own.
Correct.
Now, what is included in payroll costs? Taxes? And if the question specifically relates to taxes, it is the employer portion of the state and local employment taxes, the federal employment taxes are not included, but again, the legislation currently pending before the Senate would have those taxes included in the period. Okay. That was answered. Are retirement and health insurance costs of owners' employees eligible for forgiveness?
Retirement health insurance costs, you said, Stan?
Yes.
Those should be eligible for forgiveness.
Yeah.
Okay.
Yep, just subject to the overall cap.
Subject to the overall cap, yeah.
What percentage of ownership is considered an owner?
This is Leslie again. For purposes of the owner-employee category, this is one of the key areas of uncertainty on this, on this point. So as we need additional guidance on what's intended by owner-employee on the application. In certain contexts, there are references to owners, which include owners of 20% or more of the equity, and they're depending on sort of the category that you're looking at, it varies. And as mentioned, some of those categories we have some more instruction from the SBA than, for example, with respect to owner employees.
Okay, then we didn't get PPP until the second round, so I had to cut wages and pensions for the second payroll in April. Can we go back and repay employees that which was deducted from the paycheck and still apply that to the forgiveness calculation?
I think the answer to that is no. The forgiveness just involves a week covered period. And what happened during that period?
Well, but if it's paid during the covered period, would it be?
Oh, it's paid during the covered. Oh, okay.
Yeah.
Okay.
Okay, that's. And don't the chosen reduction periods have to coincide with the periods selected when the borrower applied? Anyone?
I don't think so.
I don't think so either.
Right.
Okay. Is wage reduction hourly rate or total compensation, including overtime? Anyone?
Well, the FTE would be 40 hours, and it's on a wage reduction. Let me take that back. Sal?
I think we might need additional details on the question and what context the question is being asked in, Stan, for that one.
So let's skip that one. Sal, the question is from a hospital foundation. Is a not-for-profit eligible for the Main Street Loan Program?
At this point, they're not eligible yet. The only indication we heard from the Fed was that they understand that obviously those entities need assistance, but given that right now the loans are calculated generally based on the EBITDA, it's not truly applicable to those types of entities. So as a general matter, the Fed and the Treasury are right now in the process of figuring out what is it that they can do with respect to those entities, and we're waiting additional guidance.
Okay, thank you. Are there any restrictions for employees who are related to the owners? I assume that means would they be counted as owners, or would they be counted strictly as employees? I mean, my view is they would be employees if they
Right.
don't own any of the entities.
Correct.
There's no the affiliation rules don't apply in that
that's my
context.
view too.
Yeah.
And this comes up a lot. If forgiveness is the lesser of loan amount or 75% of payroll, and we use the entire loan for salary expenses, will it be 100% forgiven? And I think the answer is yes. The 75% is a minimum amount that has to be used for payroll for forgiveness purposes, right. But it can be more. Panelists, do you agree with that?
Yes.
I think just subject to the potential reductions, really, it's still going to be subject to those reductions around if you've reduced your FTE headcount or your wage and salaries during the period.
Right, and it also for each individual will be subject to the cap. What are expectations about PPP loan forgiveness audits, processes, documents, etc.? Good question. Anyone want to tackle that one, or shall I?
Well, look, I mean, SBA has already made clear that they're planning to audit all. I don't think they use the word audit. They said review all applications in excess of $2 million. They've done north of 30,000 loans of that size. So that will, that's going to occupy a whole lot of their time. And, otherwise they reserve the right to review the applications of any other borrower. Although the notion of economic need is going to be granted for loans under $2 million.
Okay, I think if in terms of process, that there has been some guidance issued that the lender will submit within 60 days of the forgiveness application, the application to the SBA. The SBA will then have 30 days to come back, but the statute of limitations is for years, and so the SBA can still review these loans going into several years. So this is not something that will will necessarily go away. I think we'll take one more quick question. We're a little bit over. So the quick, is the webinar being recorded so we refer to it as we can refer to it as we work through the calculation of PPP loan forgiveness? And the short answer to that is yes, it is being recorded, and everyone who registered will get a copy of the recording. And with that, I would like to thank everyone for participating today and for attending. If you still have questions, please feel free to contact any one of us, and we will try to respond as we can. And with that, that ends the webinar. And again, thank you very much.